So, $10 million. And that's just the starting point. It's the kind of money that builds companies, that funds massive projects. It's a real game changer. But what if you wanted to get your hands on it?
You know how it usually works, right? A loan that big means you're putting everything on the line. Your company, your house, literally everything you own. So how do you tap into that institutional-level capital without taking on that crushing institutional-level risk? That's the big question we're going to unpack today.
Okay, let's dive right in. The answer, it turns out, lies in this really fascinating new financial machine being built right at the intersection of old-school banking and the new world of decentralized finance. It's a system designed from the ground up to deliver capital without you, the borrower, ever having to put up your own collateral.
All right, first things first. Let's break down the foundational idea here. I mean, how is it even possible to get a massive loan without providing your own collateral? It sounds a little too good to be true, but the mechanics behind it are actually pretty ingenious. So the solution is built on what's called a hybrid trust banking model. But the real magic ingredient, the term you absolutely have to get, is non-recourse capital. This is the core protective shield. This is what makes it all work for the borrower. So what does non-recourse actually mean? Well, it's simple, but it's incredibly profound. It means that if the whole deal goes south, the lender can only seize the collateral that was put up for the loan itself. And that's it. Nothing else. Your personal bank accounts, your company's assets, your home, they're completely off limits, totally firewalled from the deal. The risk is contained.
And here is the next key piece of the puzzle. If you're not putting up the collateral, who is? Well, the system uses something called a qualified third-party depositor. This is a totally separate entity that steps in and provides highly liquid assets, things like certificates of deposit or medium-term notes. This creates a total separation, completely decoupling you, the applicant, from the collateral risk.
Okay, so right about now, you're probably thinking, this sounds amazing for the borrower, but why on earth would any lender agree to this? Where's their protection? Well, their security comes from a really powerful concept called over-collateralization. It's basically a giant safety buffer.
And we are not talking about a small buffer here. This thing is massive. For every $10 million in capital that's requested, that third-party depositor goes out and acquires $23.5 million in collateral. That's 235%. This huge cushion is what protects the lender against market swings, credit risk, you name it. It is the bedrock of security that makes this whole system work for everyone.
All right, so we've covered the theory. It makes sense on paper. But how does this actually work in the real world? Let's bring this down to earth and look at a really cool, concrete example that almost anyone can understand, using a future tax refund. Yeah, forget about those abstract assets like CDs for a minute. Just imagine using something we all get, a future tax refund. This system has a protocol designed specifically to take your expected federal refunds and transform them into secure, verifiable collateral that can be plugged right into these sophisticated financial structures. And it's the details here that make this so incredibly robust. We're talking about all federal income tax refunds for the next 3 years, 2023, 2024, and 2025. It covers all the standard forms, even amended returns, and the most crucial part, every single piece of this agreement is recorded on the blockchain, which creates a permanent, unchangeable, mathematically proven record of ownership. So, you might be wondering, okay, how does this actually happen? How does an expected payment from the IRS get transformed into legally recognized collateral that a serious bank will actually accept? Well, it follows a very clear pathway that brilliantly blends established legal frameworks with cutting-edge tech. The whole thing starts by building a rock-solid legal foundation. First, a smart security agreement is created and locked in on-chain. Second, a UCC1 filing is made. Now, for those who don't know, this is basically a public notice that plants a legal flag on an asset. It makes sure the lender has first dibs on those future refunds, making the collateral legally ironclad. And third, key IRS forms, like a power of attorney, are securely stored, allowing the system to interact with the IRS when the time comes. And from that legal base, technology just takes over. The settlement is all automated, using smart contracts, protected by multi-signature escrow for extra security. Then, a cool AI-driven process called credit mining kicks in. It analyzes credit data to add another layer of verification to the collateral's quality. But, and this is key, it's all done with military-grade encryption, so all your personal info stays completely private. Finally, the whole package is bundled up into clean, machine-readable reports ready for institutional review. Okay, so this entire process, from the legal filings to the AI number crunching, It all relies on a very specific technological backbone to make sure everything is secure, transparent, and verifiable. So let's pop the hood and take a closer look at the engine that actually builds all this trust.
That engine is called Notary Chain, and it basically delivers 3 guarantees that are absolutely essential for financial trust. First up, you've got transparency. Because actions are on a public blockchain, anyone can verify them. More importantly, you get immutability. In finance, this is huge. It means once a record is made, it's set in stone. It can't be forged or quietly altered later. And finally, you get top-tier security, using the same encryption standard trusted by governments and militaries to protect the most sensitive data.
And what's really cool is that this technology is doing 2 very powerful but distinct jobs at the same time. One is all about making things efficient, and the other is about creating brand new financial opportunities.
So on one hand, you've got workflow automation. Think of this as the internal engine. It's streamlining all the boring but crucial stuff like compliance, record keeping, and transaction monitoring. It keeps the machine running smoothly and by the book. Then, on the other hand, you have DeFi integration. This is how the system looks outward. It connects these newly created tokenized assets to the wider world of decentralized finance, lending protocols, staking, liquidity pools, the whole shebang.
So we've seen how it works, we've seen the tech. But here's the billion-dollar question, right? How does a system this innovative actually operate in the highly regulated world of big finance? You know, to attract serious institutional capital, it has to be built on a rock-solid foundation of rules, risk management, and compliance.
And the answer is, its compliance game is incredibly strong. It's built from the ground up to meet the exact same standards as traditional finance. We're talking adherence to commercial codes for secure transactions, built-in identity verification for AML/KYC, and it even follows international banking standards for managing liquidity. The big takeaway here is this. This is not the Wild West of DeFi you sometimes hear about. This is a system built for institutional trust.
So, what can you do with this capital once you have it? Well, one of the most powerful features is executing automated trading strategies using something called flash loans. This means you can borrow millions of dollars for just a few seconds to make a trade. This table here shows live arbitrage opportunities, which is just a fancy way of saying the system finds an asset priced differently on 2 exchanges, buys it low on one, sells it high on the other, and pockets the difference, all in a single instantaneous transaction.
And the smart contracts behind all this? They're like a financial Swiss Army knife. They are incredibly versatile. You can see here they can handle all different kinds of settlements. Yeah, a lot of it is standard escrow and arbitration agreements, but they're also capable of managing complex insurance, loan, and even trade finance settlements, all automated and secured on the blockchain.
And look, this is not just some idea on a whiteboard. This platform is already operating at a pretty significant scale. We're talking about nearly $50 million in total value locked and well over $125 million in loan volume in just the last 30 days. This machine is already up and running, and it's running at scale.
So when you step back and look at the whole thing, we're really looking at a system that completely rethinks the fundamental relationship between borrowers, lenders, and collateral. It absolutely promises to unlock capital for people and projects that might have been ignored by traditional finance. But as with any powerful new machine, the final question has to be asked. Does all of this incredible engineering create a more resilient financial system, or does its very complexity introduce new kinds of risks we haven't even begun to understand yet?